Welcome to the Financial Thought Exchange, the official podcast of the CFA Institute Research Foundation. I'm your host, Lotta Moberg, and my guest today is Stephen Brown. Stephen has published in numerous articles. He has 5 books in the areas of finance and economics. He has served as the executive editor of the Financial Analyst Journal, and he now sits on its advisory council. He's been very involved in the publishing in the financial world. He's also served as the managing editor of the Journal of Financial and Quantitative Analysis and served as the founding editor of the Review of Financial Studies. He's also here as the most recent winner of the Vertin Award, which is award by the CFA Institute Research Foundation that comes from us. So we've had quite a lot of exchanges, and we're really appreciative of all the work that you've done for us and for the CFA Institute. So welcome, Stephen.
Thank you very much.
And I don't think there is one person out there who is better at talking about the topic that we want to cover today, which is hedge funds. And you have done research going back a lot of years, but also a recent one. You follow this topic and this area of the financial world for a long time. So I'm really excited to sit down with you today and ask you a few questions that I want to know and that I'm sure our audience wants to know as well. So I was thinking maybe we'll start with just the background in terms of what's the story of hedge funds? How did they come about in the first place?
Well, it's a very interesting story. You see, the originally going back in time was Franklin Delano Roosevelt was challenged to develop regulations for public funds after the Great Depression experience and the 1929 crash so the Investment Company Act of 1940 was established to basically regulate public funds. And his friends, wealthy friends who had family offices, were very concerned about limitations on what they could do. And so an exception or a safe harbor was carved out of the Investment Company Act to accommodate these family offices. But the practical political reality was that Franklin Delano Roosevelt was not able or did not feel free to say that he was giving an exemption to his friends and family who had these family offices. And so he he they developed a classification of funds or special restrictions on funds, limiting the number of funds, number of people who could invest in the funds, and the criteria to be an investor in the funds, which meant that most of the family officers were people who have great wealth, and the families weren't great in number. And so this seemed to be, he defined a family office in everything but name. Now, that was in 1940. In 1949, there was a very brilliant investment individual called Alfred Winslow Jones. Alfred Winslow Jones, he was an Australian like myself, but that's only a way of speaking because he, like I, have spent our working life in America. But he realized he could set up a fund that met these criteria, but not be a family office. And so he was extremely successful, and he had a lot of very satisfied investors. But he never publicized his work. In fact, that's one of the requirements for meeting this 3C1 exemption under the Securities and Investment Act, the Investment Company Act. And so nobody knew anything about it. And then there was an individual by the name of Carol Loomis, who was a journalist for Fortune magazine, who found out about it and wrote an article about him in 1966. And this fund, which seemed really strange to her because it didn't abide by all of the criteria that seemed to inhibit other funds. And she said, he was actually running a long short fund. And he said he admitted that he was engaged in a lot of short transactions. I said, "Isn't that risky?" He said, "No, not really at all, because these short positions are offset by long positions. In fact, they hedge the long positions." And so she took that and said, "Oh, so you're hedging?" And she said, "Yes." Well, that wasn't quite accurate, because the hedge, there's the short positions are actually very small relative to the long positions. But she coined the name hedge funds. And the name hedge funds are not an investment strategy, they're just a form of organization. Interestingly enough, what they exist and can profit because they can do things other people can't do. There's like a regulatory arbitrage that, since they can go places other people can't go, they can earn rents from that. Now, it's interesting because when I actually had a PhD student who did did his PhD on the history of hedge funds. And he went back to the debates in Congress in 1940 that that led to the Investment Company Act of 1940. And they were talking about, why do we have this exemption for these class of funds, the 3C1 exemption? And it was explained that, well, these funds are designed, they serve a public interest. And the public interest is that they provide liquidity to the markets. When nobody's willing, they buy when nobody's willing to buy. They sell when nobody's willing to sell. So in fact, they reduce systemic risk in the marketplace. And the people in Congress bought that argument and granted them the exemption, which was the reward for providing this public service to the financial system. And so, as it happens, that is the hedge funds have a multitude of strategies. There are long short funds, there are global strategy funds, there are all kinds of strategies out there. Very few of them are hedged in any meaningful sense of the word. Uh, so hedge is a very poor name for hedge funds. But
Right, because like you might think that once upon a time hedge funds were hedged and now they swerved away from their original meaning. But to your point of your story, it was never really in their original meaning to be hedged. And even
yeah.
if, as you said, the short positions would have been larger, that wouldn't be what we call hedge. That's a long short strategy that has a lot of risk exposure to it.
Exactly, exactly. So, but that is the provision of liquidity seems to be a very common characteristic of even most of these strategies, that they're very diverse in nature, that they provide, and they do serve that function, except when they don't. And I think the financial crisis of 2008, you had 15% of hedge funds failed.
So how to
So,
think about that though? Because on the one hand, you're saying sometimes the liquidity provider, if I'm a liquidity provider, I would think that I would be exceptionally good positions in liquidity squeezes, such as the financial crisis. That's when I should shine. Instead, we see the opposite. So what is this
correct.
liquidity provision
Well,
feature?
they're correct, if they had infinite amount of capital, they'd be able to do that. And indeed, a lot of the very large hedge funds did very well over that period of time. But there are a lot of small fish there, and the small fish just didn't have the capital at hand to meet they could profit as long as they survived. But a lot of them didn't survive. That's the real problem. That issue impacts the way we interpret the risk and return of hedge funds, as we'll probably talk about. But
Yeah, I mean, to give a sense of what the nature today and what you find about hedge funds, like I think that the standard view is they're high risk, high volatility, but also high returns, high fees. Obviously, it's like four, just further out on the risk spectrum, so to speak. Your research on this gives a more nuanced picture. Especially, I want to hear about the volatility part of this. Like, how
yeah,
do we?
exactly.
Is
Well,
this
I
the
mean,
money you?
the reality is, and a lot of people are disenchanted with hedge funds because they think that hedge funds earn spectacular returns, and they take high risks, but they're rewarded with spectacular returns. Well, the reality is they don't earn spectacular returns. And there was a study I read. I did a study which I published in the Financial Analyst Journal, which looked at the returns, and the returns, in terms of the hedge fund indices, are not great relative to the S&P 500. I found that, and in fact, more recent than my work, I saw a study on looking at the Barclay Hedge Fund Index, that over the period 2011 to 2020, the Barclay funds only earned about 60% return versus 265% return for the S&P 500 over that 10-year period. So if you'd invested in hedge funds, you might have well have been disappointed. And the same, I just looked March 2025 to February 2026. And over that period of time, according to the Barclay Hedge Fund Index, the Barclay hedge funds made 3.6% return over that year, and the S&P earned 19%. Even that's even accounting for the recent fall in the markets. It's still over the past year, the markets have performed 19%. So they say, well, why did we invest in hedge funds? They did not promise the return, that people
Mhm.
had, that they didn't take huge risks. Yes, they took a lot of risk, but they didn't earn the return. And look a little bit further, closer down into the data, you'll see that, well, hedge funds are not correlated with the market. In fact, they're supposed to be market neutral. That was the
Mhm.
marketing. I would hear people in the hedge fund, I'd go to these talks from hedge fund managers, and they would boast about how their funds are market neutral, and that was a selling feature of the market. That when the market collapses, we won't lose, but that also means that if the market rises, we don't gain. And I said to one of them once, I said, if I went to Atlantic City and put my money in the slot machines, that's a market neutral strategy also. You might make money, great chance you'd lose money, but whatever returns you make, they're completely uncorrelated with the market. That's not a virtue.
Right.
It's just an attribute. And the reality is that hedge funds actually, if you adjust for risk, the beta is about, historically, the beta in terms of hedge fund indices, at the index level, is about 0.21, and that's been what it has been for a long period of time. So it means that if the market rises by 100%, the hedge funds will rise by only 21%. But the same is supposedly true in the downside as well. If the market falls by a huge amount, then the fall in the hedge fund returns is greater. So that suggests that if you, for example, took a very risk-averse strategy of putting maybe 21% of your money into the S&P 500 and the remainder into treasury bills, hedge funds actually perform much better than that strategy.
Right, okay, cool, interesting,
Okay.
yeah, because
When
that
you
would be the
adjust,
obvious follow-up, like, why don't I do something like that then? Okay.
yeah, so on a risk-adjusted basis, they make money.
Right.
They don't take the kind of market risk that people attribute.
One caveat here, there's assumption behind what you're saying, I'm thinking, is that you're taking some average of an index, and then the
Yeah.
volatility is also an index. It kind of assumes that you have at least some diversification across hedge funds, which is a lot of people will have like one or two hedge funds.
Exactly, and that's the story. And people in the hedge fund industry have often made this observation. You
Mm,
know, this yeah, we've underperformed the market, but what did you expect? We're market neutral, and that's was one of our attributes. We told you that up front. That just means that when the market goes up, we're not going to go up as fast, and when the market goes down, we're not going to go down as fast. But you're right actually, that it is a diversified strategy, and the indices incorporate maybe 5,000 hedge funds that are in the Barclays index, and nobody's going to invest in 5,000 hedge funds.
On the other hand, you don't need that many exposures to get close to a diversification, right? 10, 15, maybe.
10 or 15. That's what my research shows is 10 or 15 is about enough.
Mm.
But 10 or 15 is still a pretty hefty number when you consider that the minimum investment is $500,000 typically. Does it?
Absolutely, yeah. And then the
So
accounting around paying the fees and figuring all that out,
yeah,
like, so much
exactly.
more.
Yeah. So that's and things get a little bit sticky here because a diversification of hedge funds involves other risks. There are two classes of risk that you have when you diversify the hedge funds. One class of risk, as I said, there are all these different hedge funds and they have all kinds of different strategies. But the commonality is that they earn rents from the provision of liquidity in the markets, as long as they're big enough to absorb that risk. Some of them fail on liquidity, and as I said, 15% of them will fail as a result of they tried to provide liquidity, but they didn't have enough capital to exploit those liquidity opportunities, and so they failed. But they were never meant to be small pools of money. They were meant to be very big pools of money that could, in fact, finance. But the problem is that when you diversify, they're all doing all kinds of crazy different things. But when you diversify, you concentrate the strategies into the one common thing, which is liquidity provision. So if that
Sector.
strategy fails, then everything falls down.
Mhm.
So that's why hedge funds, on average, have a lot of tail risk. And in fact, I have a study that shows that the more you diversify, the more you're exposed to the same tail risk. We all go down together.
And then another thing that you point out in your research, which is about I think it's connected to diversification, is the importance of due diligence, right? That
Correct.
a winning
Correct.
hedge fund strategy is one that can actually do due diligence, and your ability of doing due diligence decreases with the amounts of hedge funds you're exposed to, right?
Right. Exactly. Exactly. I was in Australia once, and I was talking about my research on due diligence. I did a lecture, and the dean said, "I'd really like you to talk to the university trustees who are considering a hedge fund investment
Mhm.
and about your work on." And I said, "Sure." So I go up before this body of lawyers, and they ask me about my research, and I try to explain what I'm doing. And they said, one of them said, "This is very interesting. But can you reduce your research to a simple formula that we can use?" And I said, "Let me think about this. You're thinking about investing in a fund of funds. That's a diversified portfolio of hedge funds."
Mm.
And they said, "Yes." And I said, "I think I can give you a formula." And they said, "Well, yeah, okay." And then I thought about this. I said, "What you do, if you want a formula, you form a quotient. And you have the assets under management by the fund of funds, and you divide it by how many constituent funds there are. And then you multiply that quotient by the percentage management fee, and that will come out to a number in US dollars. If that arithmetic, since you asked me for a formula, if that arithmetic comes out to less than $50,000, do not invest in that fund of funds because the
Mm.
fee covers all the expense that's the gross all of the gross expenses of the fund, all the salaries, heat,
Mm.
light, power, right? Everything, as well as the due diligence costs. If you think about that ratio, what it's saying is if you don't in the end have enough money to pay for a due diligence, which at the very least is about $50,000,
Right.
uh, you're not doing the due diligence. And
Right.
if you're not doing the due diligence, you should definitely not invest in this fund, in this
Right.
manager, because the fiduciaries are delegating their fiduciary responsibilities to the fund of funds manager. And they have a legal responsibility to ensure that the person to whom they're delegating those responsibilities is in fact doing the due diligence on their behalf. And if that formula fails, the manager is not doing the due diligence, and you are in fact responsible. And
Right.
the lawyer sat back, he was amazed. He said, "That's wonderful. Thank you very much." As as I left the room, uh, this fellow came up to me and said, "Brown," he said, "you're a hard man," because he was the fund of funds manager,
Okay.
and he did not meet the test.
Yeah, right.
He was
So
not
then
doing he was not doing the due diligence.
yeah. Well, I'm thinking due diligence, as we're kind of getting through here, is one more reason why thinking about this as a diversification strategy is just not. I'm thinking a lot of people might be listening to this and thinking, well, that's not why I want hedge funds anyway. I'm thinking about this my way to get alpha. Like instead of I'm not good at picking stocks, I'm good at picking people. So I'd rather
Right,
have something that is high volatility, high potential returns on the back of me having the judgment of the people. I know the guys over
right,
there seem very smart.
right.
And that's why I'm doing hedge funds anyway. I'm not trying to do an index here.
Right, 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 and that's the point, is that if you're going to do that, what we said about risk is only on the diversified basis. So
Mhm.
that you
Yeah, now
will
we're high
that is
risk territory for sure.
a
Yeah.
high risk that
Yeah.
is a high risk strategy. So, but that gets into, the other point about who the manager is, and that was the other piece of research I did in 2017 that really looked at the managers. Back in the beginning part of my career, I worked at a research institute called Bell Laboratories in New Jersey, and I was seconded to the AT&T pension fund. And nobody had actually at that point ever looked at the asset holdings of the fund by security. And I formed a table, and they had all of the securities in the S&P 500, how much the fund is investing in each of these securities, and what weight they are in the S&P 500, and those 2 columns were identical down to the third decimal place. So it was an S&P 500, which is understandable because arithmetically, the S&P 500 is just the average fund.
Right.
So and so they decided to index a large part of the fund, and then they interviewed all the managers. So I was in the process. I met all of the managers of the S&P of the AT&T fund,
Mhm.
and I began to be convinced that asset management was a branch of the entertainment business because these people were so interesting, and
Yeah.
uh, and you could almost imagine them going out to small pension funds in rural America, and uh, and this is like the entertainment for the week is hearing these people speak. They were really interesting.
Yeah.
Um, but it takes a lot of effort to really penetrate what in fact they're doing.
Mhm. Yeah.
And a lot of them are very obscure. Yeah, and the part of the problem with hedge funds as an asset class is because they can't advertise, they're not allowed to advertise by
Sure.
the SEC. They don't tell you very much about their activities, and all you have is the guys who are giving these dog and pony shows.
Mhm.
They don't tell you because they don't have to.
Right.
And the one of my proudest moments was I was giving a talk on hedge funds at NYU to the executive group, and I had a table with all the hedge funds that were. Then one of the people raised their hand and said, "Madoff is not in your fund in your table. Why is that?" This is in 2002. Uh, he said,
So that
"Madoff."
was before he blew up then, or?
8 years before he blew up,
Yeah.
and Madoff isn't in your list of funds. I
Mhm.
said, "No, that's correct." He said, "Why not?" I said, "Well, Madoff doesn't share any information with me, or with the public databases. He doesn't because he doesn't have to. He's a hedge fund, or at least he was there were his feeder funds were hedge funds, really.
Mhm.
But, he didn't, so and the person who asked the question said, "Well, why would someone like me or share important information with someone like you? And I said, well, if is not willing to share census type information with academics, think you really shouldn't do business with a person like that.
Mhm.
And and then the next morning, I'm sitting in my office, and the dean calls me up on the telephone. Stephen, he said, I often want our professors to have impact, and I see that you have impact. I said, "What is this?" He said, "I've just had this clown on the phone who is made of saying, 'Brown is a dangerous man. He must be stopped.'"
Oh, what an honor to be called such from the
Right.
corner.
I say that's my proudest moment as an academic.
Yeah.
He tried to buy them, they're very obscure, and that's why due
Mm.
diligence is much more expensive and complicated than it is for a regular fund. Uh,
One question about that, just curious, it comes to mind is so artificial intelligence is everywhere now. Have
right.
you gotten any sense that the world of due diligence changes with that, that it makes it easier for smaller shop to do adequate due diligence for hedge funds?
Well, it could make it much cheaper because there's a lot of information processing that's going on
Right.
in doing due diligence, uh, and what my research shows is that the triple check process is very important in due diligence. So you go and interview a fund manager, and you have to verify triple verification. You have to verify what he's saying is true. And in my research, I had due diligence reports from several hundred due diligence reports, and we looked in, and it was really interesting because these were due diligence reports before the fund failed or succeeded. They were prospective in nature. They didn't have the information, and they looked at it, and we found that a lot of hedge fund managers didn't tell the truth to their clients.
Right.
And what's really strange was it wasn't obscure kinds of information, it was public record information. Like,
Mhm.
have you ever been subject to an SEC review of your activities? Yes or no? Has the CFTC ever raised any issues? Yes or no? No. And of course, there were many violations, right? And
They
so
said no, and then they
there
actually
were.
lied on the form. Okay, yeah.
Exactly. They lied to their customers.
Mhm.
And uh, so that's why, in fact, what we found in our research was those people who lied were the people who then failed.
Mhm.
But
Right.
these are not obscure lies. These were lies that were easily found out. But,
Yeah, that's interesting. And I want to jump to another topic too about like the due diligence part.
but
One is other lying, and the other one topic you've been researching is what you call sensation seeking. So this is,
exactly.
look out for sensation seeking hedge fund managers.
Right.
Maybe we should start with why does this topic matter? We kind of touched on that, and
Well,
what are we
due
talking about here?
diligence, I think, is really the important issue.
Mm.
Just going back to the AI makes the whole process a lot simpler.
Yeah,
With
right. Yeah.
AI, you can actually train them to actually search the public records. AI is really important, and it really help in this process and reduce the
Yeah.
costs and the things
Yeah.
like
No, I feel like that's where
that.
you're
But anyway,
going with that. Yeah.
yeah, I'm kind of interested, because a lot of the due diligence that you have to do, um, is really involves things that are unknowable or very hard to discover. And, um one thing that is folk wisdom is that you should never invest with an asset manager that buys an expensive sports car. And, I've heard stories about major fund, managers that don't allow sports cars into their, parking lots because the customers might get the wrong idea about what kind of people they hired. But, there'd be no research into whether this folk wisdom and whether it was interesting or
Right.
You know, I did a study which we published in 2017, which examined this in some detail because uh, car ownership is a public record, and you can find out your manager without even having to ask him questions about what kind of. You can find out what the VIN number of cars he bought, and you can find out, does he buy a fancy Maserati or whatever. So the problem is hedge funds are supposed to take risk, and the issue is, are they taking risk to enhance the returns of their investors, or are they taking risk for the sake of taking risk? You'd think, well, obviously they're taking risks to enhance, but not necessarily. And the reason is that hedge fund industry attracts a lot of sensation seekers. Now, sensation seeking is a clinically defined term, and it's a stable personality characteristic that where individuals who are subject to have this personality trait search for novel, intense, and varied experiences. They thrill-seeking,
So like
desire.
adrenaline seeking?
Yes, adrenaline seeking, exactly.
Yeah.
Adrenaline seeking, they desire new information. Uh, they're characterized in the psychological literature as disinhibition and their boredom susceptibility. And this is a personality characteristic, and it manifests itself into people who take risk-taking, physical, social, and financial. But risk-taking by itself doesn't imply sensation seeking. If you want to be a pilot in the US Air Force, you have to go through a big battery of tests, basically to exclude sensation seekers from being pilots of aircraft. Because the very last thing you'd want to have is a sensation seeker piloting one of these billion-dollar planes in the air. That's the very last person you want. So they have this battery of tests that they screen those people out. And most of the pilots that I've met, I know they drive old VWs or very SUVs around when they get down on the ground. They don't drive
Sleeper
Maseratis.
cars. Yeah.
Exactly. So the issue is, and then the problem, I think, is, that hedge funds, they attract sensation seekers. They're very, that the whole attribute, the whole way they're organized, because hedge funds use complicated, dynamic, and unconstrained strategies. They're unconstrained because they're not subject to the constraints that apply to most other SEC-regulated funds. And they satisfy a desire for varied, novel, and intense experiences. They're managing huge sums of money and betting huge sums of money. And there's very limited transparency and regulatory oversight, which is what sensation seekers like. So the hedge fund industry attracts people that have this personality characteristic. And that's really kind of distressing. And
When
so
you go
what.
about when you're looking at this, so this is, we're talking about a piece of research when you're actually looking at this quantitatively. And like you say, it's
Absolutely.
not about risk in total level risk. It's basically becomes Sharp ratio, right?
No,
Compared
yeah,
to
what we did was we actually went out and looked at hedge fund managers. What cars did they buy, and how did this correlate to the risk and return attributes of the hedge fund? And what we found was that on all of the relevant criteria, looking at, for example, how the torque of the car that they bought, whatever whether they bought sports cars, sports car buyers as opposed to non-sport car people who bought minivans, the people who bought sports cars had considerably higher risk. Their funds exhibited considerably higher risk than the minicar fund managers. At the same time, so there was about a 20% increase in fund risk as opposed to non-sports car buyers. And funds managed by minivan owners had about a 20% less risk.
Right.
And then you looked at the Sharpe ratios. And the Sharpe ratios for sports car owners were much smaller, were negative, were lower than the market.
So that's how much return you get compared to the risk. It's a ratio between return and risk.
They took a lot of risk, but they were not rewarded for taking that risk. They had a much lower return, and the minivan owners had a much higher return per unit
Right.
risk.
And somebody reading this, somebody might think like me, looking at it and saying, maybe it's just an age thing. Like if you're younger, you're just not as good yet, and you don't have family yet, so you buy a sports car rather than SUV. But all of these things, you go through a lot of long list of objections like that and test that how that doesn't explain it.
Exactly, exactly. We presented this, and this work was highly controversial when we
Mhm.
presented. And so we were challenged on all these things. Maybe it's a gender thing. Well, unfortunately, in America, and this is another study I did, and it's interesting looking at America versus Asia. In America, there are very few female hedge fund managers,
Right.
whereas in Asia, there are many, it's almost 50-50. It wasn't a male versus female thing. We looked at age. We looked almost at every possible everything that was raised as a obvious explanation of this. And so the bottom line here was that sports car ownership is a really interesting and simple tool to use in due diligence.
Hmm.
What kind of car do you buy? Well, that's a matter of public record. You'd have some nervousness about hiring those people.
Right. Yeah. Thank you. It's fascinating research. I love that paper, and yeah, I really appreciate your time today. I think our audience learned a lot. Just as we wrap up here, I want to give you the opportunity to just, if you would share with the audience that we have here as an overview, what would you hope that people take away from your research? How do you hope that the industry changes and people's behavior as they make investments in hedge funds change, knowing what you know?
I think the bottom line here is that hedge funds provide they're an important component of the investment universe. They exist because of regulatory arbitrage. They do things other people can't do, and in principle can make returns that other people cannot make. And so there's every reason that they have a positive Sharpe ratio or positive alpha. However, there are some caveats to that. And the caveats to that are that one has to be extremely careful. One would not put a large fraction of your investment wealth into such an investment because there are significant risks. And those significant risks are not necessarily beta risk because actually the beta risk or the volatility of returns is actually quite small. It's more tail risk. Going into a financial crisis, I'd be very nervous, as we seem to be doing right now. We looks like we're headed possibly into a financial crisis. This would be a very dangerous time to be investing significantly in hedge funds, at least the very small hedge funds, and the importance of due diligence. If you intend to do this, you've got to be prepared to pay for due diligence. This is a interesting human characteristic. You never look. People don't look at the reviews of the Consumer Report reviews on the cars they buy until after they've bought their cars. In the same way, that was really interesting in our study of these due diligence reports. The people who subscribed to the due diligence reports subscribed to the due diligence reports after they had committed the funds to those investments. And otherwise, in other words, they were covering their backsides when they realized that this fund might fail, and so they went out and did the due diligence report. So they're not doing it really. And in Australia, we bought a new house, and we were astonished that, and we sold our old house. We bought a new house, and we were astonished that nobody had actually come and did an engineering report on the house before they bought it. People People don't treat due diligence with the seriousness that it really deserves. And my research shows that an appropriate scheme of due diligence can add about 2% return to a hedge fund investment.
Those are great lessons. Thank you so much. Thank you
Well,
so much, Stephen Barr, for taking your time today.
no problem at all. It's a great fun talking to you.
Thank you. And thank you, everyone, for tuning in to the Financial Thought Exchange podcast. My guest today was Stephen Brown, the winner of the latest Vertin Award, which is awarded by the CFA Institute Research Foundation. And we will see you again soon. Thank you.
For more information, please visit rpc.cfainstitute.org/research-foundation.